As a financial planner, I've managed over $140 million. I've seen exactly how wealth is made, but I've also seen the things that people spectacularly fail at when they're trying to build wealth. But there is a secret here that people are holding back from you, and it is surprisingly simple. So in this video, I'm going to show you exactly how to build a simple 5 ETF portfolio. I'm going to explain exactly what an ETF is, why you need them, and show you step by step how you can create this in your portfolio. Let's go ahead and break it down. An ETF stands for Exchange Traded Fund, and it is basically a group of stocks packaged together, which means that instead of you going out and finding 15 of the best stocks that you think are going to do well, you get to buy one thing and it can hold 1,500 stocks all together in one easy, simple package. There are different types of ETFs out there that focus on different things, and we're gonna, again, go with the top 5 that I think beginners should go with, and they're gonna build a well-rounded portfolio here. But just to give you a bit more context, there are some that only focus on energy stocks. There are some that only focus on international stocks, and your goal as an investor is to cobble together the best ones. But again, there are thousands of them out there. So as an investor, here's what your goal is. When you're sitting with a financial planner, we say that you should be looking for diversification. Your job is to get the best return for the least amount of risk. To do that, you want to spread your money across broad sectors, which means you want stocks here in the US, stocks abroad, stocks in small countries, large countries, everything in between. So here are the top 5 that I would propose that you look at, and then we'll get into the details as to why I am looking at these and then the differences, because there is one little ingredient that will make all the difference. The first one is EEM. This is the iShares Emerging Markets ETF. When we say emerging markets, these are countries on the come up. Now, generally speaking, this is a more risky ETF, but it also has the highest reward, generally speaking. High risk, high reward. I'm going to get into what we call allocations, how much money should you put into this, but this is where we'll put the least amount of money among the 5. But you do want a little bit of emerging markets. Just for context here at the time that I'm doing this video, and you can also see this on the screen, in the last, or really year to date, so beginning of the year to right now, again, the time I'm doing this in 2026, it is up 20% on the year, and over last year it's up 40%. That's pretty good, okay? The stock market on average in the US is up about 7% after inflation. This one in the last year up 40. Again, really good for emerging markets. Those are very small countries. Those things can be quite volatile. The next one is a bit on the opposite end, where you have the emerging markets with very small countries. VTI is the largest economy, and that is the US stock market. VTI is the Vanguard Total Stock Market ETF. This is perhaps the most common ETF that you may see online, especially from influencers. It's a good one. It ain't the only one that you need, but it is a very good one. And it pretty much in the title, it is the total stock market of the US. What the US stock market does, this ETF does. It is a very solid core. I would argue of all of these, you should probably put the most chunk of your money, the biggest chunk of your money, into this one. Again, we'll get into more details here in a second. But VTI, that is the next one here on the list. Moving forward, we go to VT. Right, that is the Vanguard Total World ETF. So you got the US, right, the entire US, and that's pretty spread out. Now you've got the entire world, which yes, does still include bits of the US, but it's more watered down. Now you have the entire world. So there are parts of the country parts of the world rather, that are doing quite well. Now, the US stock market, though it may be the biggest and perhaps most valuable, depending on the year that you're looking at, it ain't the only one. All right, you've got pockets in Europe like Germany that could be doing well at any point in time. You've got places like South Korea did well, very well actually, in 2025. That is the point in why you would do something like VT. So you want to have some of your money there. Depending on how you feel and where you may live, how much you put in VTI and how much you put in VT can absolutely vary. Okay, we'll get more into details there. I've hinted at that a few times. Speaking of all of that, you can go to buildingbread.com/callkev if you want me to take a look at your portfolio, and we can get into all the details about how you should be dividing up your money between these ETFs and perhaps some other investments that you may own. Those are 3 of them. Now we want to go to the 4th one, and that is SPY. This is the S&P 500. Now, some people are going to look at that and say, hey, the S&P 500, I've heard of this before. This is the top 500 companies in the US. Now, I have done my research here. Why is it that you have the total US stock market and then have the S&P 500, which is also, last time I checked, the majority of the US stock market too? Technically, no, they are not the same things. In fact, I even went to a CFA, a Chartered Financial Analyst. These are people who create these funds, and asked them, why in the world would you invest in both of these things, the S&P 500 and then something that tracks the entire US stock market at the same time? Sometimes we call this the Wilshire 5,000 stocks in the US. Why would you do both? Think of it like dilution. You have the S&P 500 is extremely strong, and honestly, we've talked about it before, it's really weighted towards, the tech stocks, Nvidia, Broadcom, Meta, so on and so forth. But something like VTI is a lot more spread out, and I would argue a bit better in terms of diversification. So you get both here. That is the reason why you're investing in both. So you get, yes, the tech weighted S&P 500 in comparison here, and you get all the other stocks that are in the US. The S&P 500 isn't everything, especially when about 40% of the value of the S&P 500 is tied up in just a handful of stocks. When I say a handful, I'm talking about 7 stocks make up close to 40% of the value of the S&P 500. That is why you also want VTI. You get the S&P 500 and VTI. There is a very, very specific reason as to why, and now you have it. Then the last one we have SCHG. That's the Schwab Aggregate Bond Index. That's pretty much all the bonds here in the US. Now, to be honest with you, most of us are not going to love looking at a chart of bonds. However, if you look at the yield, that is the bond payment, the passive income that you're going to make from these bonds, that is the point of having these bonds. Now that you have all the 5, should you take all of your money and divide them evenly? No, I do not think it is a strong recommendation to take your money and split them evenly between all of them, even though that sounds like that is something that makes a lot of sense. The reason is, everybody is in a different phase of life and has a different goal in mind. For example, the last one that I mentioned, the one that is primarily invested in bonds, its goal is not to make a ton of money. You are very, very unlikely to ever see that fund, SCHG, make 40% in a year. That I ain't never seen it. That's not its goal. It is a passive income sort of fund. Okay, it's not guaranteed, clearly, but that is what its goal is to do. Something like EEM is more aggressive. So are you more aggressive or are you more conservative? Typically speaking, the closer you are to retirement, the more you typically move towards cash and bonds. So keep those things in mind. Are you more concerned about where the US is as a country and where their economy is? That is going to inform how you should be investing those. Now, as a financial planner, this is a part of what I do, and we also add a few in there based on where I see the economy moving and what my clients like to do too. But this is the thing, if you just pick these 5, you are better than about 90% of investors because you have pretty much everything covered. Now, what are you missing? You could add some international bonds in here if you wanted to. Maybe you can add a few stocks here or there, but this is primarily it here. The other piece is the one that we talk about on this channel all the time. That is the rebalancing, the adjusting piece of it. Once you put your money in here, you do want to leave it alone, except when you need to come back and make adjustments. So for example, let's say that I have everything in here evenly, which again, no, I wouldn't suggest, but for the purposes of this conversation, it makes more sense. So if I put 20% of my money across the board, well, 6 months from now, it could be 40% in EEM, the emerging market fund, because it absolutely did well, and 1% in the bond fund because everything else did well and that one just kind of was flat. Well, my goal then is to buy and sell or just add money to get everything back balanced. That is called rebalancing. The reason why you typically want to do this is to make sure that your goals are still intact, because When you don't do this, you end up taking on more risk than what you initially set out for. You can say, look, I'm a balanced investor. I get everything balanced. This is my goal here. 2-3 years later, you look back and your portfolio is down 50%. You say, how was I taking on so much risk? I only had 5% of my money in the emerging market fund. How did it take over everything? Well, it did so well that it just grew and you weren't paying attention. You didn't sell pieces of it to cut it back down to where it was. I like to compare it to it as like cutting your yard or a garden. You might start off with a very neatly manicured lawn, and if you don't take care of it, it can overgrow and take over things that you did not expect it to. So regular maintenance is required. I like to do it twice a year. I would not recommend an ETF portfolio like this to be manicured, if you will, more than 4 times per year. The market is going to move and shake. You don't need to be in there multiple times. The secret ingredient here is simplicity. It is simplicity. My most successful investors, my millionaire clients, they keep things simple. You don't need to be on CNBC. You don't need to watch the market each and every day. You do not have to do that. What you do need to do is choose good ETFs for the most part, choose quality stocks, sit back and let the market play out. So these are my favorite core ETFs that I like to start off with and build my portfolio from. If these are the only 5 that you do, these are totally fine. And there are some substitutes here. Not everybody wants to do SPY. You can do VOO, right? Those are essentially equal. But these are the ones I would suggest you start out with if you are a beginner, and then you can slowly grow out from here. But again, if you start out with these 5, you are better than about 90% of investors. And trust me, I have seen a lot in my time in this role. If you want to learn more about investing and everything in between, make sure you hit the like and subscribe button. Also, check out these videos right here.